Yes, the value of the United States dollar USD can absolutely drop at any time due to shifts in market forces, political decisions, and macroeconomic conditions in the US and across the globe. Just like any other currency, the dollar's value is never permanently fixed. It fluctuates daily based on the laws of supply and demand within the global foreign exchange forex market. 5 macroeconomic catalysts driving the devaluation of the US dollar. The valuation of the United States dollar USD within the foreign exchange market forex does not occur in a vacuum. It operates via global supply, demand, yield differentials, and geopolitical trust. Understanding why the world's primary reserve currency devalues requires analyzing 5 foundational macroeconomic pillars. 1. Central bank monetary policy and interest rate differentials. The primary driver of short to medium-term currency valuation is the monetary policy stance of the Federal Reserve, the Fed. The mechanism of yield. When the Federal Reserve lowers the federal funds rate, it reduces the yields on U.S. Treasury securities and commercial bonds. Institutional investors worldwide seek the highest risk-adjusted returns yields. Capital outflows. If the European Central Bank (ECB) or the Bank of England BOE maintains higher interest rates while the Fed cuts rates, international capital flees U.S. fixed income markets. Investors liquidate their dollar-denominated assets and convert them into euros or pounds. Supply and demand equilibrium. This liquidation floods the spot forex market with dollars while increasing the demand for foreign currencies. Following the fundamental laws of supply and demand, an oversupply of USD paired with dwindling international demand triggers a rapid depreciation in its exchange rate value against major currency pairs, for example, or USD, GBP USD. 2. High domestic inflation and purchasing power parity (PPP). Inflation acts as a silent destroyer of currency value, governed by the economic theory of purchasing power parity. Erosion of internal value. If the US experiences high domestic inflation driven by supply chain disruptions, corporate monopolies, or excessive fiscal stimulus, the internal purchasing power of the dollar drops. $1 buys fewer goods and services inside America. Trade deficit expansion. This dynamic causes US citizens to buy more imported goods, selling dollars to buy foreign currency, while foreign buyers reduce their purchases of American exports, buying fewer dollars. The resulting expansion of the trade deficit puts structural downward pressure on the dollar's global value. 3. Structural debt accumulation and fiscal deficits. The fiscal health of the United States government directly correlates with global trust in its currency. The sovereign debt burden. The U.S. national debt expands through continuous federal budget deficits. This requires the Department of the Treasury to issue vast quantities of Treasury bonds to fund government expenditures. The credibility gap. As the debt-to-GDP ratio climbs past sustainable thresholds, international sovereign wealth funds and foreign central banks begin to question the long-term solvency of the U.S. financial system. They worrying the government might eventually print money to inflate away its debt obligations. Risk premium adjustments. To hedge against this risk, global investors demand a higher risk premium or choose to diversify away from US government debt entirely. When large-scale buyers like foreign nations reduce their purchases of US treasuries, the structural demand for the USD drops, causing a long-term decline in its exchange rate. 4. Global de-dollarization and geopolitical shifts. For nearly a century, the US dollar has enjoyed exorbitant privilege as the undisputed global reserve currency, but this structural monopoly is shifting. Weaponization of the financial system, the aggressive use of unilateral economic sanctions, asset freezes, and the weaponization of the SWIFT banking system by Western powers has created deep geopolitical anxieties among non-aligned nations. The rise of alternative networks. Major economic blocs, specifically the expanding BRICS alliance, Brazil, Russia, India, China, South Africa, alongside newer members, are actively building alternative bilateral trade settlement mechanisms. Diminishing structural demand. When nations bypass the dollar to settle multi-billion-dollar energy contracts, such as paying for oil in Chinese yuan, Saudi riyals, or UAE dirhams, the global banking system needs to hold fewer petrodollars. This structural shift permanently lowers the baseline global demand for USD. 5. Shifts in global economic growth differentials. Currency markets act as a scoreboard tracking relative economic performance across the globe. Relative growth rates. Capital is attracted to regions experiencing high economic growth, technological innovation, and expanding corporate profit margins. The diversification of capital. If the US domestic economy falls into a deep recession, stagnation, or structural decline while emerging markets or the European Union show robust, tech-driven GDP growth, international investment capital shifts. The portfolio rebalancing effect. Global fund managers rebalance their multi-trillion-dollar portfolios by selling US equities and real estate to acquire high-growth assets in foreign jurisdictions. This massive capital migration requires selling dollars, directly undercutting its value on the global stage. Systemic domino effects of a weakened dollar on the global economy. Because the USD serves as the primary currency for global trade, debt contracts, and commodity pricing, a decline in its value sends shockwaves through every continent. 1. Global commodity price volatility and imported inflation. The international trade of primary commodities such as crude oil, natural gas, gold, copper, wheat, and soybeans is almost exclusively priced in US dollars. The inverse pricing relationship. When the value of the dollar drops, it takes more dollars to purchase the exact same physical barrel of oil or metric ton of wheat. Therefore, a falling dollar naturally causes commodity prices to spike on global exchanges. Imported inflationary pressure. For countries that rely heavily on imported energy and foodstuffs, such as many nations across Africa, Asia, and Europe, a falling dollar makes these vital resources expensive in terms of their local currencies. Socioeconomic strains. Even if a country's internal economy is stable, it imports inflation directly from global commodity markets. This strains household budgets, spikes transportation costs, and forces foreign central banks to raise interest rates, slowing down their own economic growth. 2. Restructuring of sovereign debt dynamics in emerging markets. Many developing nations and emerging market economies borrow money from international lenders by issuing bonds denominated in US dollars. The relieving mechanism. On one hand, a depreciating dollar provides temporary relief for these debtor nations. Because their local tax revenues are collected in domestic currency, a weaker dollar means their local currency strengthens against the USD. This makes it cheaper to buy the dollars needed to pay off their national debts. The hot capital threat. However, this benefit is frequently wiped out by the volatility of hot capital flows. As the dollar weakens, speculative international capital floods into emerging markets looking for higher returns. Asset bubble formations. This massive influx can artificially inflate local real estate and stock markets. When the economic cycle turns and that capital leaves quickly, it can destabilize the local financial system. 3. Disruption of global trade balances and export competitiveness. A shifting dollar changes the competitive landscape for international trade, turning winners into losers overnight. The American export advantage. A weak dollar makes American manufactured goods, software, and agricultural exports cheaper in foreign markets. A European or Asian company can buy US goods using fewer euros or yen. This boosts US manufacturing and helps American multinational corporations increase their overseas profits. The foreign exporter disadvantage. Conversely, foreign nations that rely on exporting to the US market suffer. Their goods become more expensive for American consumers. The risk of currency wars. For export-driven economies like Germany, Japan, and China, a weak dollar hurts their domestic manufacturing sectors. This can push foreign governments to intentionally devalue their own currencies to stay competitive, sparking global currency wars and protectionist trade policies. 4. Valuation shocks to central bank foreign exchange reserves. Central banks around the world hold massive portfolios of foreign currencies, known as foreign exchange reserves, to defend their local currencies and back their financial systems. The loss of paper wealth. Historically, central banks have held over 50% to 60% of these reserves in US dollar assets and treasury bonds. When the dollar loses value, the purchasing power of these trillions of dollars in global reserves drops. Forced asset diversification. To protect their national wealth, central banks are forced to rebalance their portfolios. They reduce their dollar holdings and buy other assets like euros, Japanese yen, Chinese yuan, or physical gold. Loss of faith. This forced selling by global central banks creates a feedback loop that weakens the dollar even further and reduces confidence in the US financial system. 5. Strains on global capital flows and investment realignment. The global investment landscape must adapt when the primary currency used for funding and corporate accounting loses value. Rethinking risk management. International institutional investors, like pension funds and insurance firms, manage their portfolios based on currency risks. A weak dollar reduces the returns on US assets when measured in foreign currencies. Shifting to real assets. This encourages a flight away from paper assets like cash and bonds and toward tangible, real-world assets. Capital moves into global real estate, infrastructure projects, and companies with strong pricing power. Rising instability. The global financial system becomes more volatile as massive amounts of money move around searching for inflation-protected returns, creating asset bubbles and market swings across different regions. 3 strategic compartments for individual wealth preservation. When the baseline currency of the global economy loses value, traditional savings methods can erode your purchasing power. To protect your wealth, you must shift from passive cash savings to active asset allocation. Strategy 1. Allocation to gold and tangible precious metals. Gold has served as the ultimate store of value for thousands of years because it cannot be printed, devalued, or manipulated by central banks. Zero counterparty risk. Unlike a bank account, stock, or bond, physical gold does not rely on any bank, corporation, or government to fulfill its promise. It is an independent asset that carries no default risk. How to implement this step? 1. Physical bullion. Buy high-purity 99.9% gold coins or minted bars from accredited refiners. Store them securely in private, non-bank vaults outside the traditional financial system. 2. Avoid digital paper gold. Avoid basic retail bank gold certificates or speculative paper derivatives. These can be frozen or face liquidity issues during a systemic financial crisis. Focus on holding the actual physical asset. Productive corporate equity. Beyond real estate, look to invest in blue-chip corporations that own essential infrastructure, utility networks, or consumer brands with strong pricing power. These companies can pass higher costs directly to consumers, maintaining their profit margins and paying reliable dividends even when the currency is weak. To dot broad equity investments, use low-cost, globally diversified index funds or exchange-traded funds ETFs that hold real businesses with physical operations, global revenues, and strong balance sheets. Strategy 3. Currency diversification and multi-jurisdictional cash management. Relying entirely on a single national currency leaves you vulnerable to domestic economic missteps. True financial security requires diversifying your cash holdings across multiple currencies and jurisdictions, mitigating single-point failures. If your savings are entirely in US dollars, a drop in the dollar's value directly reduces your global purchasing power. By spreading your liquid savings across a basket of strong currencies, you protect your wealth from a decline in any single country's economy. Selecting hard currencies. Look for currencies backed by stable political systems, conservative fiscal policies, and strong trade balances. Good examples include the Swiss franc CHF, the Singapore dollar SGD, or the euro, or for broader regional diversification. How to implement this step? 1. Multi-currency bank accounts. Open accounts with international banks that allow you to hold and switch between USD, EUR, CHF, and SGD within a single dashboard. 2. Offshore banking jurisdictions. Move a portion of your liquid reserves to stable offshore financial centers like Switzerland or Singapore. This protects your capital from domestic asset freezes, capital controls, and local banking crises. Underscore. The integrated trading matrix. This comprehensive synthesis provides a clear action plan based on different economic conditions. Use this matrix to guide your portfolio adjustments as global conditions shift. Underscore. In conclusion, the value of the United States dollar USD can absolutely drop as a result of shifting interest rates, high national debt, or changes in global trade dynamics. Because currency markets are driven by supply and demand, the dollar is never completely stable. Its strength fluctuates constantly in response to both American economic policy and global financial trends.